With housing prices recently surging, the average American homeowner now has around $300,000 worth of home equity. Many are talking about taking out a home equity loan or HELOC to pay off their mortgage. But what is that, and is it a good idea? NTD's Evelyn spoke to Vance Ginn, the president of Ginn Economic Consulting and the former chief economist at the Office of Management and Budget. Let's take a look.
Basically, it's refinancing, getting into a situation where you're looking at how much equity you have in your house equity loan sort of situation here, and trying to find a way to bring down the interest rate if you can, and potentially reduce the number of years of payments. In this case, 5 to 7 years. Some could be 10 years. It just kind of depends on how many years you want to look at it. But it's a way to try to bring down your payments and maybe refinance for a lower interest rate, which is tough in the current environment.
Is it generally a good strategy to try nowadays to, to cut the interest payment that way?
Yeah, well, I mean, with a HELOC or a home equity line of credit, right? You're looking at a situation where sometimes it's good to take out that equity you have in your home to expand or build a back patio or a pool or something else at your home, or just kind of redo some things around the house. But some other people would say, you know what, go ahead and refinance it entirely and get a second mortgage, and then that way you can buy other things that you want along the time, especially with higher inflation and everything else that's going on right now and the financial situation. But again, interest rates have soared over the last couple of years. They went from 3% a couple of years ago to now 7%. And so many people are going to be in a situation where it's going to be too costly for them to go out and get that home equity line of credit.
So what exactly should people look at to figure out if this is a good idea or not for them personally?
I think the key things is look at your financial situation, your amount of income that's coming in, your savings, and then look at your interest rate. How does it compare to where it is on your mortgage now to what you could get? And do you want to move? I mean, there's a lot of instances where people want to move either way because they want to move into a better neighborhood, they want to find a better city to live in or something else. So there's a lot of situations we need to look at, and also understand that the financial situation is such that there's a lot of liquidity out there. So a lot of banks are wanting to give out more lines of credit. And so just really look at the details of that to make sure that you get the best deal possible and that's best for your family.
So any risks that people should be aware of, or would you say that's also in the fine print and differ from bank to bank?
Yeah, I think it's different bank to bank and also different person to person, depending on what those interest rates are going to be and how much you're going to have to pay for the fees, because sometimes there's pretty high fees associated with getting those refinances for home equity loans and everything else that really could come into play. I also think we need to look at the financial sector and say, you know what, should we be giving out as much loans as possible, given that so many people are behind on their mortgages right now, is another situation to look at. So really be cautious with how much additional credit that you get and how much equity you pull out of your house. One thing I would mention here is if home prices go down, which they could, in some places they're already going down 8 to 10%, that could also reduce the amount of equity you have in your loan. So if you get that additional home equity credit, you go from $100,000 to $120,000 and the home price goes down to back to $100,000, you're not going to have as much equity to finance that mortgage over time. So that's another key part to look at whenever you're thinking about getting in a home equity line of credit.
That's definitely a very great point and an important point as well to mention. I really appreciate your insights this morning, as always. Vance Ginn, thank you so much.
Thank you.